Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Bill Neville, and Bill is a certified IRA services professional. I guess you use the initial CISP. We all have to have these little initials after our names. Anyway, he works for the Entrust Group, and that is a self-directed IRA custodian. Bill joined the Entrust Group over 5 years ago as manager of operations for the company's franchise program. And when the program was discontinued, Bill became the manager of the compliance and internal audit department. And then he kept Entrust's educational programs and internal processes in line with industry regulations. But now he is the business development manager for Entrust's San Francisco Bay Area office, which is actually in Oakland, isn't that right?
It's Oakland, yeah. It's our headquarters.
Okay. Anyway, today Bill and I are going to be talking about investing in real estate using your IRA or Roth account. And as we get started with that, I want to caution our viewers that we're discussing issues in actually a complex area. And so this should be just a starting point for a bigger discussion. And we want you to get qualified legal and tax advice. So, Bill, thank you for joining me today.
Thank you for having me.
All right. Bill, to get started, why don't you tell us a little bit about how you got into this whole area of offering independent trust services for IRAs?
Well, Entrust has been in business for 35 years. So Hugh Broma, the owner of the company, he started the business in 1981. So I obviously haven't been around since the beginning of the company. I just was looking for a career change, and I found this position that had opened up, the manager of franchise operations job, and that's how I ended up with Entrust. I actually didn't really know anything about self-directed IRAs. I'd heard about it, but I didn't really have a good concept of what exactly they were, which in doing my job, I'm coming to learn that people either have never heard of it at all, or their knowledge is pretty much similar to when I started with the company, which they heard of the concept but don't really have a lot of experience with it. And so for my job as business development manager, I try and get the word out and get more people educated about the concept of self-directed IRAs. But like I said, the company's been in business for 35 years. I've been with the company for a little over 5.
Okay, good. So, yeah, this is an unusual animal. We've been talking about these self-directed IRAs since I've had the show, partly because I was involved with the San Jose Real Estate Investors Association.
Sure.
And had learned some things about it. Why would someone consider the alternative of a self-directed IRA with an independent trustee or custodian like Entrust?
Well, so one of the things that we promote, one of our sort of advertising slogans, I guess, is invest in what you know, right? And most people who have a retirement account, they have it with a traditional brokerage firm. They have it with a Charles Schwab or Fidelity or Vanguard or somebody like that. And those firms limit you to investing in stocks, bonds, mutual funds, and CDs. Mm-hmm. So most people who have a retirement account, they probably started with a 401k with a company, and that provider was a big brokerage firm who limits you to those investments. The IRS, however, doesn't limit you to just stocks, bonds, mutual funds, and CDs. The IRS says you can invest in virtually anything you want. You just have to have the account with an administrator or custodian that allows for those investments. So that's where the self-directed IRA industry, we're in existence to fill that niche for people who want to invest in what we call alternative investments. So the reason why people would do that really is very simple. If there's an investment out there that they want to make that they feel like can grow their retirement account better than the traditional stock, bond, mutual fund market, then that's the reason to have a self-directed IRA. So with real estate, for example, people in the real estate, or people who know real estate, people research real estate, or people in the real estate industry, they might be interested in putting their money in real estate rather than being invested in, some mutual funds that a broker is recommending to them because they have more knowledge of it. Mm-hmm. It also provides a different way to diversify your portfolio, right? So if you have a retirement account and you're invested in 4 or 5 different mutual funds, and there's a a small stock fund and large cap and international fund, and there's these different types of funds, and a lot of brokers will say, well, that you're now well diversified, but you're still all in the stock market, right? And so even though those funds might move at different percentages, they tend to move in the same direction that the broader market goes. If the market goes up, those funds tend to go up. If the market goes down, they all tend to go down. Whereas if you hold real estate or precious metals or private equity, they're not necessarily going to move in the same direction that the market is. So it's I don't want to use the term better, but it's certainly a different diversification than just holding different mutual funds within the stock market.
Okay. How is your service different from a self-directed plan at a bank or brokerage company? So they call sometimes their accounts self-directed, but the service that you offer at Entrust is different. Maybe you can explain that a little bit.
Yeah, I mean, if they're saying it's self-directed, they're saying you can pick your own mutual funds and stocks, right? Mm-hmm. But you still tend to be limited to stocks, bonds, and mutual funds. The brokerage firms, a lot of them do tend to have a true self-directed option where they will allow for alternative investments. They'll allow for private equity. I don't know if they'll allow for real estate. They'll certainly allow you to invest in private equity, but they tend to limit those to their really, really high net worth clients. So the big brokerage firms, for just the average investor, they're not going to allow you, if there's a private company out there that you want to invest in, they're probably not going to allow you to hold it if you're not one of their net worth. And they're almost definitely not going to let you hold real estate. That's just not their business model, right? They make their money based on a client investing in mutual fund stocks in which they're then going to get a commission. They're going to get a load on that investment. Whereas in the self-directed industry, we're not selling or recommending or endorsing any particular investment. We're just administering the account. So we don't charge any fee we charge fees. We don't charge any commission when somebody purchases an investment because we're not selling an investment, right? We're just administering the account. So we charge, in their industry, we charge administrative fees. And it's a very different business model than what the traditional brokerage companies have, the banks and brokerage firms.
Mm-hmm. Mm-hmm. Okay. So what kind of retirement accounts does Entrust handle?
So we have, so if somebody wants to do a traditional IRA or a Roth, IRA, if you're individual, if you're a small business owner, you can open a SEP, a simple, or a solo 401k. So you have to be an individual business owner, their spouses and their partners can do a solo 401k. You can also self-direct a health savings account and educational, what's called a Coverdell educational savings account. So we offer those plans as well. So somebody who's part of a high deductible healthcare plan can open a health savings account and self-direct that into whatever they want, as well as somebody who's wanting to save money for their children or grandchildren or whoever, student education. They can open a self-directed educational savings account and self-direct that as well.
Okay. Why would someone want to invest in real estate through an IRA or a Roth account?
Well, again, if somebody thinks that the real estate investment is the best way to grow their retirement account, then that's really the only reason to invest. So if there's a real estate investment out there that somebody wants to make, and a lot of times they might not have the money in their checking account, or they might not have the ability to obtain the mortgage that they want through their checking account, but they do have the money in a retirement account, and that's where the money is. Mm-hmm. But it's a way to make the investment and grow it. With a Roth, you grow it tax-free, right? If somebody buys real estate within their IRA and they rent that out, the rent's going to go into their Roth, the property is going to increase in value, hopefully, and that's all going to happen in an account with no tax consequences, right? It grows completely tax-free as long as they start taking distributions after they reach 59 and a half and have the account for at least 5 years. A traditional IRA grows tax-deferred. With a traditional, you have to eventually pay taxes when you start taking distributions. But the fact remains is that you're not going to be subject to capital gains tax. You could have your IRA buy the property and the IRA sells the property, and you don't have to 1031 exchange it because it's occurring within a tax-deferred vehicle already, so you get the tax benefits of that. But I come back to the reason why anybody would make any investment within an IRA, whether it's the stock market, whether it's real estate, whether it's precious metals, whether it's private equity, whatever it could be. The reason to do it is because they feel like that's the best investment that they can make to grow their retirement account.
Okay. We'll get into some more details because there are some wrinkles to what some of the things that you're talking about.
There are, sure.
Yeah, we'll get into that later. Okay. So, who's responsible for preparing the income tax returns? Well, I guess we'll get into that a little bit. Let's talk a little bit about some of those wrinkles. So, there are some situations where an IRA or a tax-exempt entity in general can have taxable income. And maybe you can talk a little bit about how that works for real estate.
Correct. So what you're talking about when it's associated with real estate is what's called unrelated debt finance income tax, right? So that occurs if your IRA is using leverage to purchase a property. So there's a few different ways that you can use your IRA to invest in a property. You can have your IRA buy it all with cash, right? You have $500,000 in your IRA and there's a property out there worth $400,000, so it just pays cash for it, right? But let's say there's a property out there that's worth $400,000 and you only have $300,000 in your IRA. So you could, as the account holder, you could put a certain amount of money into the property, and then your IRA borrows the rest of the money through what's called a non-recourse loan, right? So, so in this example, let's say the property is $400,000, and your IRA borrows $200 of that $400,000. So your IRA put in $200,000 and it borrowed the other $200,000. So that means that 50% of the income generated by that property is subject to what's called unrelated debt financed income. So if the property made let's say $20,000 that year in rental income, so $10,000 of that would be subject to that tax, right? So, and it's at a little bit of a different tax rate. It's at a trust tax rate. It's not at the standard income tax rate. It's a little bit of a different tax rate.
Right. So, the tax return, or IRS, I guess they call it unrelated business taxable income. Unrelated, so it's an unrelated business tax, and like you said, it is subject to a trust tax rate. And the first $1,000 of income is tax exempt. It's a small exemption.
That's correct.
But there is a tax return that has to be filed for this. And some people are surprised to learn that an IRA could actually have to file an income tax return.
Yep.
I actually had to do one of these for somebody last year. It was quite an exercise. Anyway, who's responsible for preparing that income tax return?
The client is.
Yeah.
Yeah.
So that's another thing. People need to understand that they may think that the custodian is taking care of everything.
Right.
But there is this matter of getting the income tax return prepared. And that is responsibility for the account owner.
Right.
And so they need to understand that going in.
Yeah, when it's unrelated business income tax or UDFI, they're essentially the same thing in two different ways. UDFI is when you're using leverage, whereas unrelated business income tax, if you basically are operating a business within, but it's the same essential rules, that the $1,000 exemption, and they do have to file that tax report.
It is still unrelated business income. But it's become business taxable income because of the debt.
Right.
And so for you guys, that's a way to keep it straight in your mind for when you're explaining it to your customers. Okay. So there's also the situation that when you sell the property, again, if it's debt financed, then the gain, a part of the gain could actually be taxable as well.
Correct.
Yeah, so people need to understand that. So.
Right, depending upon where they're leveraged at that point, what percentage of it is leveraged.
So you want to have it paid off before you sell the place.
Ideally, yeah.
Okay. as a real estate investor, what things can you do and what things can't you do when real estate is held in an IRA or a Roth account?
That's a good question. So what you're talking about is what's called prohibited transactions, and particularly associated with disqualified persons. So the investment in real estate is for investment purposes only, and it needs to just be for the benefit of the IRA. So there are certain people who can never stay in the property or work on the property, and those people are called disqualified persons. And the disqualified person is the account holder, the account holder's spouse, the account holder's ancestors, so parents, grandparents on up the line, the account holder's lineal descendants, so children, grandchildren on down, and then spouses of lineal descendants. So as an example, if someone buys a property, let's say in a college town where they have a child going to that college, their child's not allowed to stay in that property. They're not allowed to pay rent. They're not allowed to stay for free, either one of those. They're considered disqualified persons. That would be what's called a prohibited transaction if they do that. And the consequences potentially can be pretty severe if the IRS determines that you committed a prohibited transaction, and that your entire IRA becomes distributed to you at the point that the prohibited transaction happened, and that potentially is a taxable event to you. So you definitely want to make sure that you don't commit a prohibited transaction, and that's one of the roles that we play with Entrust, is to help people with that, to make sure that they understand that, to be there if they have any questions on what may or may not be a prohibited transaction. We can explain that to them.
Yeah. So one thing I guess that I like to point out to people is that this isn't something that a solo thing, something that you just try to do by yourself. You really need to get some good advice all the way around. You need to have a good tax person.
Right.
You need to have a good custodian that provides maybe some educational services and information, and possibly even have a good attorney that's involved as well.
For sure, yeah. I mean, and I'm glad you brought that up, and you'd mentioned at the very beginning, anytime we do, like I do a presentation, I do, as part of my job, do a lot of presentations to groups as often as I can, and the first thing we do is we put up a disclaimer that says, we're not accountants, we're not financial advisors, we're not lawyers, right? We're not CPAs. We are administrators of self-directed IRA, and you should have people that you talk to. You should have an accountant, you should have a lawyer, financial advisor, whoever that you utilize for that before you make any investment decisions, right? Because we're not going to help with the investment decisions. We're just there to make it legal for you to hold those alternative investments within your retirement account.
Yeah.
And that's the full role that we play. But education-wise, we do have, we're big on that. We provide a lot of educational information, not only on self-directed IRAs and how they work, but also a lot of different alternative investments out there. There are a lot of really interesting investments that, frankly, I didn't know anything about until I started working for Entrust. And it's
we're going to have a whole program
discussion about that.
On that.
Different types of investments.
Yeah. So we'll talk a little bit about that. But one of the things, again, I want to point out to people that this is very sensitive stuff, and so. You need to be careful of not trying to handle things out of your own pocket. So I had a situation, this was a really sad situation, of a client who their renters paid them cash, currency, dollar bills,
right,
for their rent, and they received it personally.
And their IRA owned the property?
And their IRA owned the property. So that is a prohibited transaction.
That's correct.
So that blew up the thing. And then they used the cash to pay some of the expenses for the property. And so they thought, it's all, it's all the property,
Right.
And no big deal. And then I had to tell them, no, I'm sorry, we've got a problem here. Now your whole account is taxable.
Right.
And unfortunately, it was an Entrust client, and so we.
Oh, is that right?
I had to work with you guys to work through that with the client. There are some things that sometimes, if you have an accident, there are some procedures that the IRS has in the Department of Labor, because unfortunately, these things they come under both of those.
Right. That's correct.
So you can get waivers related to prohibited transactions. But it's an expensive process, and usually you have to get an attorney involved and
Yeah.
so on in order to do it. So you just need to be very careful that everything needs to go through an account that's underneath the fund. Now, sometimes you can have like an LLC
Right.
that's owned by the IRA, and so it enables you to do things like write checks and to make deposits into a bank account. But even then, it's sensitive, and you cannot get any income. You can't take anything out personally. It all has to be handled according to Hoyle.
That's correct.
So that you get distributions the right way and the right reporting is done.
Yeah, you mentioned, real quick, you mentioned the Department of Labor. A lot of times, I'll get a call sometimes where people want to do something that, particularly when it involves investing in a private company, it might be a company that they have partial ownership in, et cetera, and it kind of falls in a gray area, right? It's not that black and white. Like the Internal Revenue Code, not everything's really black and white. We will encourage people to get an advisory opinion from the Department of Labor. There is no cost to do that, and that's something that we would often encourage people to do ahead of time before making the investment or before making some of those decisions, is get something in writing from the Department of Labor.
Yeah. So the Department of Labor may not charge you for giving you the advice, but again, if you're doing it right, you're going to have to get help. You're going to need to pay legal fees. You're going to need to pay maybe a CPA to help you or whatever, or an enrolled agent. So anyway, but it's worth the investment is what we're saying.
Sure.
You need to get that assurance. And again, it may be that something that could normally be a prohibited transaction, you can get a waiver.
Mm-hmm.
And again, that may be an expensive process, but again, it pays to keep yourself out of trouble. So there is another little thing that's sort of a more recent development, and I'm not sure if you know much about it or not, so I'll just ask you, are there annual valuation reporting requirements for IRA and Roth accounts?
Yeah, I mean, the fair market value, we send an email. We send an email to our clients on an annual basis with a fair market valuation form and ask them for them to provide to us a recent fair market value for the asset that's being held in the account. So things like private equity and real estate, they're not publicly traded. We can't just go to the open market like you can with precious metals. We can and get a fair market value. So we have to go to the client and ask them for it. If we don't get one provided to us, if the client doesn't provide one to us, then we continue to show the fair market value that was in the account the previous year. But we do ask for it on an annual basis.
Okay. So people need to understand, well, first of all, this becomes even more important when you get to retirement age.
Sure.
But the IRS now has, there's a form 5498,
Mm-hmm.
and basically what it does is it says, here's what the value is of what's in your account. And now the IRS is asking for additional information for these types of assets. And so you just need to be aware. Now, real estate, actually, we're kind of fortunate. I mean, there's a big industry of appraisal. Mm-hmm. And so you can get appraisals, in many cases fairly inexpensively for property, especially residential real estate. Mm. Anyway, who's responsible for getting the valuation? I think you just...
Well, the client is, yeah. But the client has to provide us either documentation or a third-party signature on the fair market valuation. So for property, for example, they can go to a realtor's realtor that they work with and have them run comps and provide that fair market value. So they don't have to go so far as to pay for an appraisal, right? They can get that as long as it's being provided by a professional, right? A third party. A CPA could be the person who signs off on the fair market value.
I'm not going to do that, but anyway.
But it could be, right? I mean, depending upon the investment that's being made, right?
Yeah.
Maybe not necessarily with real estate, but some other investments like private equity, things like that. We do see that.
We'll get into that again in the other program. But I want to focus mostly on the real estate.
Yep.
But well, there are other sources, and particularly for when you don't have a distribution that's dependent on it. So the distribution, once your retirement age, is determined based by dividing the balance in the account by a life expectancy figure.
Right.
And so you have to have a good number for that once you get there. And personally, I would recommend getting the appraisal for real estate myself. But there are sources like Zillow and so forth where you can get pretty good numbers. And again, it's not as sensitive during your before you reach retirement age.
Yeah, I mean, retirement age it's right. The requirement on distribution age is 70 and a half. Right. That's when people are subject to requirement on distribution. And you're right. Then that fair market value becomes pretty critical because you're going to have a calculation of what you're required to take at that point. And it's going to be based on the value of all your different retirement accounts. And if you have an alternative asset in there that's not necessarily easy to define the value, it becomes pretty key.
So sorry we're out of time. Bill, thank you for joining me. Hope we've given you something to think about. We'll see you next time on Financial Insider Weekly.